Lithium just smashed through $2,000 per ton for the first time since October 2023. Battery-grade lithium carbonate has rocketed past $20,000 per ton. After years of brutal price crashes, mine closures, and industry devastation, lithium is roaring back, and the rally is gathering serious momentum. Is this the beginning of a new lithium boom, or is this just another false start that will crash and burn like 2023? The answers will determine which Australian lithium miners survive and which ones dominate the next decade. Welcome to what industry analysts are calling lithium's most dramatic price recovery in 2 years. Spodumene concentrate, the hard rock lithium mineral that Australia produces better than anyone else on Earth, has surged from around $920 per ton in November 2024 to over $2,000 per ton in January 2026. That's more than doubling in just 2 months. But here's what makes this rally different from the speculative frenzy of 2022. This time, the fundamentals are actually tightening. Supply is being cut, demand is diversifying beyond electric vehicles, and Chinese policy changes are creating genuine supply disruptions that can't be wished away. Let's dive into what's really happening in global lithium markets, why Australian miners are suddenly back in the game, and whether this price surge has staying power or if it's setting up for another painful correction. The lithium market just lived through what traders are calling the darkest hour, a brutal 2-year downturn that crushed prices, bankrupted marginal producers, and forced even world-class operations into care and maintenance. From peak prices of approximately $6,000 per ton for spodumene in early 2022, the market collapsed to lows around $740 to $800 per ton by August 2025. Think about that magnitude, an 85% price crash. This wasn't a correction, this was carnage. Australian producers, Mineral Resources, placed its Bald Hill mine into care and maintenance. Core Lithium suspended operations at Finniss. Galaxy Resources temporarily halted Mount Catlin. Even Liontown Resources, backed by a $230 million Australian dollar federal government loan, struggled with production challenges. The cause? Oversupply met weakening demand. After the electric vehicle boom of 2021-2022 triggered massive investment in lithium production capacity, new mines came online globally just as EV sales growth slowed. Global lithium extraction surged by approximately 74% from 2016 to 2017, predominantly driven by Australian spodumene production. By 2023-2024, the market was drowning in excess supply. Australia felt the pain acutely. As the world's largest lithium producer, accounting for 46% of global supply, Australian miners depend heavily on strong pricing. When lithium carbonate prices in China fell from approximately $76,000 per ton in January 2023 to around $23,000 per ton by November 2023, the economics for Australian spodumene concentrate exports became brutal. Here's the painful reality. Australia exported approximately 1.98 million tons of spodumene concentrate in the first half of 2025, up only 2.8% from the previous year, despite new production from Liontown Resources. Volume was basically flat, even as prices were collapsing. And 94% of those exports, 1.86 million tons, went straight to China for processing. When Chinese refineries stop buying or demand discounts, Australian producers have nowhere else to go. The market couldn't sustain those depressed prices indefinitely. Basic economics kicked in. When prices fall below the cost of production, supply gets cut. And that's exactly what started happening in the second half of 2025. Multiple factors converged to tighten lithium supply and trigger the current price rally. Let's break down the key catalysts driving lithium from the depths of despair to 2-year highs. First, Chinese regulatory intervention. In August 2025, battery giant Contemporary Amperec Technology, known as CAT, suspended operations at its Jianshawa lipolite mine in Jiangxi province after the operating permit expired. This wasn't a small mine. This facility was one of the world's largest lithium sources, capable of producing approximately 65,000 metric tons of lithium carbonate equivalent annually. That's roughly 6% of global lithium supply removed from the market in a single shutdown. CAT stated it was seeking a permit extension, but provided no timeline for restarting production. The halt was expected to last at least 3 months, immediately tightening global lithium availability. When a mine this size goes dark, markets notice. Then came more regulatory tightening. In December 2026 and January 2026, Chinese authorities in Jiangxi Province, a major lithium hub, announced plans to cancel 27 mining permits as part of Beijing's anti-involution campaign. This campaign targets what Chinese regulators view as destructive price competition, where producers sell below cost just to maintain market share. So we've got supply tightening through mine closures, permit cancellations, and production discipline. And we've got demand diversifying and growing through energy storage expansion. That combination creates the fundamental support for higher prices. But will it last? That's the critical question for Australian lithium miners betting their futures on sustained price recovery. Let's talk about what industry analysts are actually forecasting, because projections vary wildly depending on who you ask. On the bullish end, Ganfeng Lithium's chairman Li Liangbin projected a 30 to 40% rise in global lithium demand by 2026, suggesting prices could reach between 150,000 and 200,000 yuan per ton. That's approximately $21,000 to $28,000. Some projections call for spodumene prices to peak around $3,250 per ton this year. These bullish forecasts point to the supply deficit emerging in 2026-2027. Research firm Katusa Research forecasts a small lithium deficit in 2026. Fast Markets predicts a potential supply deficit of 2 to 4% in the global lithium market for 2026-2027. After years of surplus, even a small deficit can drive substantial price appreciation. Barrenjoey analysis suggests global battery energy systems battery shipments could grow 40% in 2026, supporting robust demand. When combined with ongoing EV sales growth expected to exceed 20 million units in 2025, representing about 25% of all new cars sold, the demand outlook appears strong. On the more conservative end, Benchmark Mineral Intelligence expects lithium carbonate prices to stay between $15,000 and $17,000 per ton in 2025, with potential weakness in 2026 if supply increases faster than demand. Australian broker Bell Potter recently lifted its spodumene price forecast to $1,750 per ton by year-end 2026, up 89% from its previous estimate of $925. Notice Bell Potter's forecast of $1,750 is still below current spot prices around $2,000. That suggests either the market is ahead of fundamentals or Bell Potter is being extremely conservative. Analysts often lag price moves, updating forecasts after markets have already rallied. The bear case warns that current prices have moved well beyond the typical cost absorption capacity of downstream processors. When lithium concentrate prices surge, battery manufacturers face margin compression unless they can pass costs to EV manufacturers. If they can't, demand destruction could follow. Some analysts express concern that the November-January rally has slightly surpassed expectations and represents speculative excess rather than fundamental tightening. Dennis Ip, analyst at Daiwa Capital Markets, warned the market is overlooking the pace of supply growth and that it won't be easy to pass stronger lithium prices to downstream buyers. There's also the seasonal factor. The first quarter typically represents the traditional off-season for power battery demand. If lithium demand softens seasonally, while some suspended mining projects resume production, prices could face cyclical correction pressure. The key risk? China. China controls approximately 70% of global cathode materials and over 95% of synthetic graphite production. China accounts for about two-thirds of global refined lithium supply. When China implements export restrictions, cancels permits, or changes tax policies, global lithium markets move. But Chinese policy is unpredictable and can reverse quickly. In October 2025, China introduced new export restrictions on advanced lithium-ion batteries, key materials, and production equipment. These controls were expected to delay production timelines and complicate sourcing for manufacturers outside China. But if China reverses course to support domestic manufacturers, lithium supply could flood back into markets. The bottom line on forecasts? Nobody really knows. Lithium markets have proven spectacularly difficult to predict. The 2022 boom crashed harder and faster than anyone expected. The 2023-2024 oversupply lasted longer than anticipated. Now the 2026 rally is moving faster than most analysts projected. What we do know, approximately one-third of global lithium production is estimated to be unprofitable at prices below $1,000 to $1,200 per ton spodumene. At current prices, around $2,000, even high-cost marginal producers can operate profitably. That creates incentive for idled capacity to restart, which could add supply and pressure prices. For Australian lithium miners, the critical question isn't whether prices will hit $3,000 or stay at $1,500. The critical question is whether prices can stabilize at levels that support profitable operations and justify expansion investment. Let's examine how Australian producers are actually positioned to benefit from this price recovery, because not all lithium miners are created equal. Australia's lithium industry is anchored by world-class deposits with exceptional geology. The Greenbushes mine remains the largest hard rock lithium mine worldwide, producing approximately 1.5 million tons of spodumene concentrate annually through the Talison lithium operation. Greenbushes is operated through a joint venture structure where Chinese company Tianqi Lithium holds 51% controlling stake alongside American chemical giant Albemarle with 49%. In the 2024 fiscal year, Greenbushes produced 1.41 million tons of lithium concentrate despite brutal market conditions. A third chemical-grade processing plant is under construction with expected completion in late 2025, which will increase annual capacity to approximately 2.14 million tons. When lithium prices recover, Greenbushes captures enormous value due to its scale and low-cost position. Pilbara Minerals operates the Pilgangora operation, another major Western Australian lithium producer. The company plans to boost lithium ore production by 50% over the next year through its P1000 project. Pilbara delivered strong production in fiscal year 2024-2025 and is positioned to benefit significantly from higher spodumene prices. IGO Limited, which holds approximately 25% indirect interest in Greenbushes through the joint venture structure, provides Australian investors exposure to the world's premier lithium asset. When Greenbushes produces 2 million plus tons of concentrate at $2,000 per ton instead of $800 per ton, the profit impact is massive. Liontown Resources began production at its Kathleen Valley mine in July 2024 with expected annual output of 500,000 tons of spodumene concentrate. The operation is backed by a $230 million Australian dollar federal government loan, demonstrating government support for domestic lithium production. Liontown produced 294,421 tons of spodumene concentrate in its first production year, though with some operational challenges that resulted in production below guidance. The company's average realized prices declined through fiscal year 2025 as markets bottomed, but at current pricing levels around $2,000 per ton, Kathleen Valley's economics improved dramatically. The mine features high-grade lithium reserves and modern processing infrastructure. Mineral Resources operates multiple lithium operations, including Mount Marion. The company reduced spodumene output in fiscal year 2024-2025 after placing its Bald Hill site into care and maintenance in late 2024. This production discipline positions MinRes to benefit when prices recover sufficiently to justify restarting idled capacity. At spodumene prices around $800 to $900 per ton, Bald Hill couldn't generate adequate returns. At prices above $1,500 to $2,000, the economics shift dramatically. MinRes can selectively restart capacity when profitable, providing operational leverage to price recovery. Liontown Resources and Sayona Mining both suspended production when lithium prices crashed below operating costs. These marginal producers face tough decisions: restart operations now and capture the current rally, or wait to see if prices stabilize at higher levels. Restarting mines requires capital, staffing, and time. There's always risk that prices crash again before operations fully ramp. Galaxy Resources, now part of Alchem after a merger, operates the Mount Catlin mine near Ravensthorpe. This operation has experienced multiple cycles of suspension and restart based on lithium pricing. In September 2024, owner Arcadium Lithium announced plans to potentially place Mount Catlin into care and maintenance again by the first half of 2025. But here's the plot twist. Rio Tinto finalized its massive $6.7 billion acquisition of Arcadium Lithium in late 2025, right before the 58% lithium price surge. Industry analysts are calling this move a masterclass in counter-cyclical investing. Rio Tinto absorbed Arcadium's diverse lithium asset base just before the surge, positioning the mining giant to capture higher margins through the recovery phase. Rio Tinto now leapfrogs into position as a major lithium producer. When one of the world's largest mining companies makes a multi-billion-dollar bet on lithium right before a price surge, that signals confidence in long-term fundamentals. For Australian producers collectively, the benefit of higher prices is substantial, but varies by cost structure. The lowest-cost producers, like Greenbushes, can remain highly profitable even during price downturns. Mid-tier producers face volatility, but can generate attractive returns during price recoveries. Marginal high-cost producers face binary outcomes. They're either profitable during booms or shuttered during busts. Australian lithium exports were valued at $5.2 billion in fiscal year 2025 and are forecast to reach $8.2 billion by fiscal year 2030. That forecast was based on assumptions of modest price recovery and continued volume growth. If current price levels near $2,000 per ton spodumene persist or increase further, export values could exceed those projections significantly. Australia accounted for 36% of global lithium extraction in 2024 and is expected to remain a leading supplier despite North America and Africa increasing market share. Strong Australian exploration expenditure, up from just $1.4 million in 2015 to $298 million in 2024, representing 27% of the global total, supports the long-term production outlook. Western Australia's geological advantages remain overwhelming. The region's pegmatite formations contain some of the world's highest-grade lithium concentrations. These ancient rock formations concentrate lithium-bearing minerals through specific geological processes that occurred billions of years ago. Competitors struggle to replicate these natural advantages through technology alone. But Australian producers face a critical strategic challenge. They're raw material suppliers in a value chain where China controls processing. Approximately 94% of Australian lithium exports go to China for refining. Australia mines the ore, ships it to China, and Chinese refineries capture the value-added processing that turns spodumene concentrate into battery-grade lithium hydroxide or carbonate. This dependency creates vulnerability. If trade relations deteriorate, if China develops alternative lithium sources, or if China restricts imports to support domestic producers, Australian miners could face demand destruction regardless of global lithium fundamentals. Some progress is happening on domestic processing. Albemarle operates a lithium hydroxide refinery at Kemerton in Western Australia. Tianqi Lithium Energy Australia operates the Kwinana refinery, though that facility has faced significant financial losses, and Tianqi halted construction of the second production line in January 2025 due to unfavorable economics. Building profitable lithium processing in Australia faces enormous challenges. Chinese refineries benefit from scale, established infrastructure, government support, integrated supply chains, and proximity to battery manufacturers. Replicating that ecosystem in Australia requires massive capital investment, long-term offtake agreements, and sustained government support. The Australian federal government recognizes these challenges. The $230 million loan to Liontown Resources represents one example of support. Future policy may include additional incentives for domestic processing, strategic investment in battery manufacturing, or measures to reduce dependence on Chinese refineries. But in the short term, Australian lithium miners benefit most from higher spodumene concentrate prices, regardless of where that concentrate gets processed. When prices surge from $800 to $2,000 per ton, Australian producers capture that value immediately through export sales. The question is sustainability. Can prices hold at these levels? Will supply discipline continue? Will energy storage demand growth offset any EV sales weakness? Will Chinese policy remain supportive? Here's the sobering reality about lithium markets. They're volatile. The commodity has demonstrated spectacular boom-bust cycles. Prices can surge 100% in months, then crash 80% over 2 years. Forecasting with confidence is nearly impossible because supply-demand balances shift rapidly. Let's examine the bull case for sustained higher prices. Energy storage is fundamentally structural, not cyclical. Unlike automotive demand that follows economic cycles, grid-scale battery storage is driven by renewable energy deployment. As countries commit to decarbonization targets, they must build energy storage. There's no alternative technology currently competitive at scale. This creates baseline demand that supports lithium pricing regardless of EV market fluctuations. Current prices may already price in optimistic demand scenarios. If energy storage growth disappoints, if EV sales stall, or if alternative battery chemistries reduce lithium intensity, demand could undershoot expectations. When markets discount future growth that doesn't materialize, corrections are brutal. Supply can ramp faster than expected. Idled mines can restart quickly. Delayed projects can accelerate. New discoveries can advance rapidly. Chinese domestic production can expand. If supply growth outpaces demand, the 2023-2024 oversupply returns. Speculative trading amplifies price moves in both directions. When futures markets get involved, prices can overshoot fundamentals. The recent surge may partly reflect speculative positioning rather than pure supply-demand tightening. When speculators exit, prices crash. Chinese policy is unpredictable. Beijing could reverse export restrictions, restart canceled mines, or flood markets with supply to support domestic battery manufacturers. Depending on China for 94% of export demand, while China controls regulatory levers, creates enormous price risk. Technology could shift. Sodium-ion batteries, solid-state batteries, or other chemistries could reduce lithium requirements. Battery recycling could create secondary supply. Efficiency improvements could reduce lithium consumption per vehicle or storage installation. The realistic scenario probably lies between extremes. Lithium prices are unlikely to return to the extreme highs of 2022, where speculation drove absurd valuations. But prices are also unlikely to crash back to $700–800 per ton, where one-third of global production is unprofitable. Most industry participants expect lithium to find equilibrium in the range of $1,200–1,800 per ton for spodumene concentrate. That's the zone where marginal production remains viable, where demand growth continues, and where neither extreme oversupply nor extreme shortage dominates. At current prices around $2,000 per ton, markets may be slightly ahead of sustainable fundamentals. Some modest pullback wouldn't be surprising. But if energy storage demand growth materializes as forecast, if Chinese supply discipline holds, and if EV sales stabilize or grow, prices could consolidate at elevated levels rather than crashing. For Australian lithium miners, this creates interesting investment dynamics. Companies with low-cost operations and strong balance sheets can thrive across a wide range of price scenarios. Greenbushes remains profitable even at $1,000 per ton. Pilbara and Mount Marion are competitive at moderate prices. These assets provide resilience. Higher-cost marginal producers face binary outcomes. They're leveraged plays on price. If lithium sustains above $1,500 to $1,800, they generate attractive returns. If prices crash to $900, they shut down again. Investors need to understand which producers they're buying and the break-even dynamics. The biggest strategic opportunity for Australian lithium might not be maximizing near-term profits from high spodumene prices. It might be using this price recovery window to invest in processing capability. When lithium prices are strong and cash flows are robust, that's when companies should invest in refineries and value-added processing. If Australia remains purely a raw material exporter, the country captures only a fraction of total value. Chinese refineries transform $2,000 per ton spodumene into battery-grade lithium hydroxide worth $20,000 per ton. That processing margin is where real profits exist. Some Australian companies recognize this. Covalent Lithium is constructing a lithium refinery in Western Australia. Pilbara Minerals has explored joint ventures with South Korean partners for processing. IGO and Tianqi operate the Kwinana refinery despite current losses. Building domestic processing during a price boom makes strategic sense. Capital is available, offtake agreements are achievable, and government support is strong. Using the current price surge as a window to invest in processing infrastructure could position Australia to capture more value long-term. But this requires long-term strategic thinking, not short-term profit maximization. Companies and governments must resist the temptation to simply enjoy high spodumene prices and must instead invest in moving up the value chain. The lithium price surge of late 2025 and early 2026 represents a genuine improvement in market fundamentals, not purely speculative froth. Supply is actually tightening through mine closures and regulatory actions. Demand is actually diversifying through energy storage growth. These are real changes. But sustainability requires continued discipline. If producers flood markets with new supply at the first sign of price recovery, oversupply returns quickly. If energy storage deployment disappoints, demand growth stalls. If Chinese policy shifts, everything changes. Australian lithium miners are well positioned to benefit from the current rally. World-class geology, established operations, proven reserves, and competitive cost structures provide fundamental advantages. But dependence on Chinese processing creates strategic vulnerability that must be addressed. The answer to "Is the boom back?" is nuanced. Lithium has entered a recovery phase supported by improving fundamentals, but this is not a return to the irrational exuberance of 2022. This is market rebalancing after brutal oversupply. Prices may stabilize at elevated but sustainable levels rather than surging to extremes. For investors watching Australian lithium miners, focus on low-cost producers with strong balance sheets that can thrive across price scenarios. Companies with processing capabilities or partnerships that capture value beyond raw ore. Operations with diversified customer bases, reducing dependence on Chinese demand. Management teams that demonstrate capital discipline rather than growth at any cost. Projects with exceptional geology that remain competitive even during downturns. The lithium story is far from over. Energy transition requires massive lithium consumption. Australia holds world-class resources. Chinese processing dominance will eventually face competition. Technology continues advancing. But the path forward won't be smooth. Expect volatility. Expect boom-bust cycles. Expect geopolitical complications. Expect technological disruptions. The miners that survive and thrive will be those that combine geological advantages with operational excellence, financial discipline, strategic processing capabilities, and adaptability to rapidly changing markets. Is the boom back? Maybe. But this time, sustainable success requires more than just riding a price surge. It requires building resilient businesses that can navigate whatever lithium markets throw at them next.